All right, Leslie, stay right here. We want to bring in another voice to this conversation as well. Peter Boockvar is the Chief Investment Officer at Bleakley Advisory Group. He's also a CNBC contributor. And let's start with just a couple of points. First of all, yields right now in the Treasury market are pretty calm. No serious concern about this. In fact, equities were higher on the idea that this would actually boost growth. Where do you come down on that, Peter?
Well, it's one of those situations that it doesn't matter until it does. I try to figure out, okay, when does it start to matter? It may not start directly in the Treasury market. Maybe it shows up in the dollar. Maybe it shows up in what we've seen in the price of gold that investors are beginning to question. Now, domestic investors have actually been given a gift with higher interest rates because more and more over the past 10 years, the U.S. deficit has been financed by U.S. domestic buyers, whether that's the saver, whether that's the Fed, whether that's the banking system. The foreign ownership of U.S. Treasuries has gone to about from 50% 10 years ago down to 30%. So it's a question of how do they behave in response to our deficits. But it's not just us that has the issue. Japan has an issue. The UK has an issue. And this global bond police is driving around the world's neighborhoods, not just in the U.S. So yes, will it matter at some point? But maybe it's just reflected in other things before there is a response in the Treasury market.
Obviously, running a big deficit like this, big problem, 6.2%. It's one that we've built up over a lot of time. Leslie, I'll ask you what you heard from people about whether they thought this tax bill should get passed. And then, Peter, what you think would have happened if the tax bill didn't get extended?
Well, I think most people who are considering themselves deficit hawks would say that this was a good opportunity to find a way to really chip away at the deficit in more of a pure play fashion, kind of similar to the conversation we had with former Treasury Secretary Robert Rubin, where in the 90s they really went kind of line by line in the budget to see what was the best way to kind of be more fiscally disciplined. Most people we talk to, though, and I think it's important to note this, that they don't want necessarily a balanced budget. Nobody really wants to pay off all of our debt. The importance is really reining it in so it doesn't start to crowd out other areas. It doesn't create a situation down the road. And when we say down the road, this could be anywhere from next month to 20 years from now. To Peter's point, we don't know kind of when this could be an issue, when this exactly will create some sort of confidence problem here, that they say that basically it's important to do things prudently so that you don't risk finding out what happens.
Peter, you think it would have been a disaster if the tax cuts didn't get extended?
And you also point out that saying you're blowing out the deficit by not including, okay, if you didn't pass the tax cuts, how much of the $3 trillion that is forecast would we not be talking about? Not passing the tax cut. Most of that is not if you hadn't passed the tax cut. So you're adding in something that everyone assumed was going to happen. So it's almost a faux addition to the debt that we're talking about here. It's almost like the Medicaid cuts. A 20% increase over 10 years in Medicaid is not a cut. And that's what we're talking about.
Exactly. All we're doing is extending existing tax rates. And we don't have a tax problem. 17% of GDP is tax revenue, and it's been that way, give or take, for decades. It's that spending is now 24% of GDP versus 20.
Right.
That is the big problem. And that's why the CBO, I know it's very easy for people to say, okay, well, the CBO says, yes, if the tax cuts weren't extended, this is what would happen. But if they were not extended, the economy would tank. Because right now, what I see in the first half of this year, the economy has slowed on average in the first 2 quarters, and you've got to merge Q1 and Q2 together because of the sort of timing impacts of tariffs and the behavior of pull forward and thereafter. And we're only growing around 1%. And therefore, having those tax cuts expire would have been a mess.